Rahul Arora as well, CEO of Nirmal Institutional Equities, joins in. Hi Rahul, good morning, it's Amina. We've got more than we wanted. Some argue that this is bad economy, others say it's good politics. What is your view? Do you think the road ahead is looking better than the one behind us?
So good morning, Samina, and thank you for having me on the show. I think it was pretty much par for the course. I think if you look at the commentary that's been coming out of the US over the last 4 or 5 months, general economists out there believe that the Fed was actually running behind the curve. I think they were under a lot of pressure after the ECB cut by 50 basis points. So I think some would argue that they were behind the curve. And then, in about a month and a half, they go into elections. So there can't be any rate movement now between now and the elections. So I think they've just sort of bought a little bit of extra powder and gone ahead with 50. Our own economist, Teresa, doesn't believe that this is going to be the start of a 50 basis point sequence of rate cuts. She believes, if anything, it will be 25 basis points. And, if you go back all the way to Paul Volcker and if you see, the kind of economy and the interest rate environment that was there until now, any quote unquote recession that has been Fed led, and this is what the Fed is trying to do, it's trying to cool down the economy by raising rates, has been very shallow and short lived. So I don't think people are going to be too fussed about this entire rate cut cycle in the US. The only thing is, what could it mean for India? My sense is this will put a little bit of pressure on the Reserve Bank of India. I think they'll have to move their stance to neutral in the next meeting that they have. And we were forecasting our first rate cut in India in February of next year. That may get probably advanced to maybe December's meeting this year. So I think all things considered, even that we're expecting just about a 25 basis point. But I think the market will digest this and move on. Like I said, I think it's a culmination of sort of maybe being a little behind the curve and probably not being able to do another one before the election. So I think all things considered, we're okay.
Okay, so all things were considered were okay, maybe a little better than okay, Rahul. Tamanna here from the perspective of emerging markets, because for us the big question is, are the fund flows coming in now more aggressively, and then where are they going? And Macquarie has an interesting note out this morning where they're talking about NBFCs becoming attractive. Is that something that you agree with, that if you're looking at India financials right now, maybe the upside is on NBFCs from our perspective, and which ones do you like?
So I think from a market perspective, Tamanna, I think if you remember a few months back when we had a conversation, I said that this was going to be a year where India competes directly with capital with the United States of America. I didn't see too many other economies being, beneficiaries of flows that were coming in. And over the last 1 month or so, you've sort of seen the FIs return in some gumption. That could also be a factor of the fact that, the mutual fund industry has done so well, and, the size that it has reached. And there was probably this entire feeling of FOMO, or the fear of missing out. So they've sort of participated. Now, your question, particularly on financials, is an interesting one because the one sector that has absolute value in this market today is BFSI. But the thing hasn't been moving, and partly because it is so overowned by FIIs and technically actually underowned by FIIs. So I think if you look at most mutual fund portfolios, you'll find that they're either neutral to underweight banks, and some of that probably found its way into IT and FMCG over the last 3 or 4 months. So that was a technical positioning that funds had taken. Now the question is, obviously, with what has happened with the FIs in the last 1 month or so, can this be a fillip to the BFSI sector in India? Now, we're talking about a situation where till very recently banks were hiking deposit rates. Deposit mobilization was a challenge. So there was a talk of extended pressure on net interest margins. But if you get into a situation where people believe that the rate hikes are done and we're going to get into a situation of rate cuts, and on top of that, if you're looking at about a 13-14% kind of credit growth, I think interest in the BFSI sector could return faster than most people are anticipating. The FSI part of the BFSI has anyway been doing well. I think if you look at as recently as yesterday, what were your biggest gainers, right? You had the Bajaj twins, you had Shriram, and the guys that have done well. Insurance has been doing well. So our own sense is we're overweight on this sector. We would play BFSI through insurance. We like ICICI Pro and SBI Life. We would play through housing finance companies. We like HUDCO, which is Housing Urban Development Corporation. We like Repco Home Finance. We love the gold finance theme. I think if you remember yesterday after Powell cut the rates, gold actually had a bit of a spike. We like Muthoot there. So there are pockets of NBFCs where we see value and that we would advise clients to buy even at these levels.
Rahul,
You're very, very bullish on everything but pure play banking. What do you feel about HDFC Bank? If you looked at mutual fund data from the last few months, they've actually sold aggressively or sold out of an HDFC Bank. From at this juncture, would you buy an HDFC Bank or would you buy an SBI? Or would you buy neither? That's an option too.
I'd buy both, Samina. I think, if you had an SIP that could invest in two stocks, I'd buy HDFC and SBI. I think, we've discussed this before. I think SBI at what, 16, 17% return on equity is still coming to you at what, just about 1.8, 1.9 times book on a consolidated basis. Is still a no-brainer to me. I think they've got their house in order. There are no concerns on asset quality. HDFC, the consolidated entity, had dropped down to as low as 2 times price to book. I think if you remember, the standalone HDFC Bank at its peak used to trade at even 5 times, and the consolidated entity is giving you growth in excess of 25%. Now, I'm not saying that valuations need to reset to those heydays, but if you look at most private sector banks in India today, the larger ones, they're probably trading between 1.5 to 2.5 times price to book. I think IndusInd Bank would be at the lower end of that, and maybe ICICI Bank at the upper end of that, give or take. It could be a 0.1, 0.2 here or there, but that's broadly the valuation range. I don't think that's paying too much for this kind of sector with the kind of potential of growth that it has. Uh, SBI has been one of our top picks for a very, very long time. I know the stock's more than doubled. It's probably 2.5x, but like I said, I think the valuation gap, of about 0.5, 0.6 with the market leader, I think that can still correct by about 20-25%. And I think people are getting too pessimistic on HDFC. I think there will come a time where people will reward this. I think there is some short-term pressures on margins, and I think people are taking that, into cognizance. But for the growth, these valuations, I think, I would actually, try and do an SIP just into SBI and HDFC Bank if I would.
Rahul, morning, Neeraj here. As the pre-opening rates have settled, other sector that comes into focus is consumption. You know this very, very closely, but I'm asking about a specific bucket, which is the liquor companies as a result of this Andhra Pradesh policy change. Some bit of the rally has already happened, presumably because of that or the market moving up. Is there more juice left here?
So, Neeraj, we've been very bullish on United Breweries for a very, very long time. I think we were very aggressive buyers when the stock had dropped down to a 35 times EV EBITDA. I think it's now trading at close to about 53, 54. So I don't think there's too much juice left on United Breweries. You could get a potential short-term trade there, but we did upgrade United Spirits recently. You mentioned one state, there is also Karnataka. So there was taxation and distribution related issues with both these states. Our assessment when we had upgraded the stock a few weeks back was that both these issues on taxation and distribution will get resolved. We do have a situation, Neeraj, where by and large, if you look at consumption trends in India, beer is consumed predominantly in summers. Obviously, it helps that you have the IPL and there's a sporting event, but hard liquor is considered to be more a winter kind of a drink. And I think with the festive coming up and getting into winter, and the fact that these distribution and taxation changes are happening on a relative basis, I think when we look at valuations, United Spirits looks like a better bet to us. I think if you look at consumption as a whole over the last 15 months, this has been the best pocket of the market. And I think you can include names like Radico, Globus, Sula. All of these stocks have gone up anywhere between, I don't know, 35, 40% to about 70, 80%. But I think my expectations of returns from here, Neeraj, would be a bit tempered. I think even though we've upgraded United Spirits, I don't think we probably look at valuing this company at more than a 15-20% kind of upside if you were looking 1 year out. I think earnings will continue to give you good returns over the next couple of years of about 18-20%, maybe even a little bit more if things go right. But we're probably getting towards the upper end of the valuation in this sector is my assessment.
Rahul, the next chase will now be to find the next trigger for the markets. The rate cut is behind us. US election shouldn't be too much for us. Is it going to be all about earnings from here on or valuations? Because we do need something to talk about and worry about every day.
Well, I really don't know how to answer that, Samira, because I think, I've got the market calls so wrong for the last few months. I mean, if you were here talking 6 months back and you had said it'd be at 25, 26,000, I'd said there's probably a zero probability of it. See, I think what's happened, Samina, is earnings growth since you brought that up in India, by and large, across sectors, has been a function of margin expansion. It's not been so much top line growth. There have been a couple of sectors here or there, but by and large, it's been margin expansion that's led the earnings growth. incrementally from here, I think it'll be very difficult to squeeze out very material margin expansions across the board, whichever sector you take up, banks, IT, FMCG, the ones that really matter in terms of weightage. So I think from here, it's going to be more top line driven. Now, wherever you see visibility is where you will go in and buy those particular sectors. We've discussed BFSI ad nauseum. I think probably because you had a slowdown of infra spending in the run up to the general elections. If that revives in a material way, I think as a second order beneficiary, we could look at cement. I think that could be an interesting theme to potentially be playing. I think in pockets, maybe there is value now emerging in chemicals. I think that's another space that we could potentially look at. I think IT, since you've been discussing it, while valuations are not cheap, at least we have reasonable free cash flow and dividend yields. So I think there are still some names that can be bought into. So I'd probably tilt my position more towards banks, cement, IT, and a little bit of chemicals. In terms of triggers, I don't see too much on the horizons. I mean, I think crude's dropped down to 65. Everything is pretty much out of the way. I think if anything, there could be a negative shock that hits us from here, and we need to brace for that because, I'll tell you hand on heart, Sabina. I think if you ask my entire analyst team to value their companies on a 1 year forward and put realistic price to earnings multiples and not the P multiples justified by, liquidity, my sense is 75 to 80% of the stocks under my coverage would become sell ratings. And that itself is a statement. The valuations have gone into the land of the absurd, but, as they say, it's just about crossing that Lakshman Rekha once. Beyond that, then it's anyone's guess where it could go. So I think it's going to be a trigger like market.
Haven't we already, Rahul, crossed that Lakshman Rekha and several times over? When you're saying brace for what's to come, in your view, what are the possible triggers on the horizon? Where you're saying, and you're right, a big statement, that 70 to 80% of stocks under your coverage could have a sell rating at some point. What is the trigger that you see possibly coming in?
See, I don't know what that trigger essentially will be, Tamanna, but I would remind your viewers that in the run-up to Lehman's crisis, there was a lot of literature written in the US about how mortgage-backed securities were being repackaged and sold and how there was a crisis coming. This literature was actually being written since 2006. Now, obviously, because Lehman happened, we went back and read. So it's, hindsight is always better than foresight. But there is literature being written in the US about the fact that the US economy could be on a shaky wicket. Now, could that be a trigger? I don't know. But, I'll tell you something that a fund manager told me about a couple of months back. He's like, or rather, this was just after the budget. He said, see, Rahul, we've had a pandemic. We've had US interest rates at all-time high. We've had inflation. In India, you've had capital gains taxes, raised. You've had BJP lose an election. He's like, in sab ke baad agar market nahi gira, to ab kyun girega? That to me, was complacency of a different kind. And people now sort of believe that the market just can't correct because a lot of the first-time investors who come into the market post-COVID haven't seen a correction. And I'm not talking about those 1,000, 1,500 point corrections that you've had each, you've had one of those each day in the last 3 months. You've had one day each, whether it was a yen carry trade, the day of the budget, so on and so forth. But they get very easily bought into. So what can correct the market, I don't know. But what I can tell you, is we were the first people on the street to downgrade defense to a sell, and we did that a month and a half back on valuations. People gave us flack. They said, it'll keep doing well. Good luck. But I think, as media and as brokers, we have a fiduciary responsibility to tell our clients and viewers that, there is everything at a price. You can't, just keep buying something because liquidity is chasing it. I think, for example, Neeraj is wearing a very nice suit right now. If he's paid 10,000 for it, he might, pay 12,000. But at 15,000, even he may start thinking, do I really need to pay that?
I don't know if you know Neeraj enough.
I think that responsibility needs to be there.
Yeah, well, I'll reserve the comments on the suit, Rahul. We can talk about yours.
I hope I haven't underpriced it, Neeraj.
I'm saying you're being modest because I know your suits aren't that underpriced for sure. But be that as it may, Rahul. Just one question, though, follow-up here, Rahul. I mean,
sure.
The markets have looked expensive at 22,000 as well, right? I mean, and so the calls of doubt, and if people, I completely buy your point, fiduciary duty to caution at excessive levels, and there were excesses at 22,000 when promoters like Whirlpool sold a year ago or 9 months ago. People said, oh, the promoter knows it best. Why are people buying? And the stock has rallied another $1,000 from there. So what, I mean, let's take a stand. I mean, at these levels, would you, if you were an individual investor, sit on an X% of cash if you're so negative? Or would you believe that you will rotate into more value accretive names, banks, for example?
I'm so happy you raised that point, Neeraj, because, you know, if you go back to pre the lockdown, when promoters were selling stakes, the stocks used to get derated. Abhi line lag jati hai. You know, when promoters are talking about selling stake, people are lining up. But what's very interesting, Neeraj, and I'm so happy you raised this point, just look at the extent of promoter selling that has happened in the last 3 months. That number is close to 1 lakh crores, if not higher. And you know, when I have spoken to some promoters and even some fund managers who've spoken to promoters, a lot of that selling, mind you, has found its way into the market. The source of liquidity may be changing. It, you know, the kind of promoter selling that you've seen in the last 2 months has been 2x the SIP flows. So last month you saw 45,000 crores of promoter selling. SIP flows were about 23,000. So you had 2x the promoter selling than you had SIP flows. And that money is finding its way back in. So when we talk about sector rotation, which was the second part of your question, you're also having liquidity rotation. You're finding new ways of money coming into this market because, you know, if you getting into a sense where promoters are saying, okay, I can make more money by investing in the market than my own business. Look at the discounts at which promoters are selling, Neeraj. I think I'm sure you're keeping a tab. I mean, you know, when we as brokers do deals, you know, of even 50 and 100 crores, we are fighting for 50 paisa, 1 rupee. But these are coming at 5%, 7% discounts, and they're happening very easily. I mean, these are reasons for stocks to derate. Now, the second part, Neeraj, is I'm not saying that I am negative on the market. I'm just saying that you need to be cautious because as I was telling Tamanna, I don't know what can hit us. We just need to be prepared for something to hit us. And to your point about sector rotation, which is what I was saying earlier, banks is a no-brainer for me. I would definitely move away from sectors like EMS, you know, anything to do with consumer durables and electricals, anything to do with defense. Some of these sectors are getting very, very overpriced, and most of these are in the mid and small caps. I think I read an interview by Naren recently where he said, you know, there is deep value in large caps. I completely agree with that. Large caps are trading at a substantial discount to their mid cap counterparts. And you guys were discussing IT. Just look at the valuations of everything from Wipro to TCS and compare that to everything from a Coforge to a Persistent. You will get your answer right there of the kind of valuation differential that exists. So I would definitely look at finding value in this market in sectors like cement, IT, banks. Sorry, yes, please go ahead.
Sorry, Rahul, keen to know what you're thinking about the primary market excitement. Are you calling it euphoria? Are you calling it insanity? And are you are you buying into all of the primary market excitement which is coming in? Because that's where most of the action seems to be.
Let me reverse that question, Tamanna. After listing, would you buy Bajaj Housing? That will answer your question.
I think a lot of people were waiting for the first 2 days for an opportunity.
Well, Tamanna, at listing, it's already gone to 6.5, 7 times. I mean, what kind of money do you want to make? I think if my memory serves me right, Bajaj Finance at its peak used to trade at that. And there was an operating history of having grown at 30, 35% for a very, very long time. I think Group Finance at one point used to trade at 8, 9 times price to book, but that was a company that never diluted in its history. So I think one of the reasons why you're seeing a lot of interest in IPOs, Tamanna, is that people are actually bereft of ideas. Let's be very clear. It's very difficult to find a new idea in this market because most of the liquidity is still concentrated in the top 100, 150. You're like, ठीक है, अगर IPO में invest कर लिया तो आपको कम से कम allotment तो मिल जाएगी. Then you can always sell it in the secondary market. So I think that's part of the reason why you're seeing this frenzy, because the kind of money that's coming in, I mean, just look at the fact sheets of SBI Mutual Fund, ICICI Prudential Mutual Fund, HDFC Mutual Fund. The number of companies these guys are owning 10% off is not a joke. I mean, it is at all-time highs. And in cases where they are not able to do it alone with the funds, they're tying up with their insurance arms and collectively owning. And these are not just mid-cap companies. These are even banks. I mean, I think even IndusInd Bank is 10% owned by one fund. I don't think people realize that. So I think that's probably...
No, so from what I'm understanding, you are skeptical about the kind of frenzy. Are you saying you're not excited by an NSE IPO coming in, possibly a Swiggy?
No. So let me correct you there. I'm saying this is not a statement in aggregation. There will always be exceptions to the rule. Now, look, you had Zomato that listed went to 200, came down to 40, and then realized that they had to focus on cash flows and profitability, and the market has rewarded them. If Swiggy maintains the same line, you'll obviously see that there'll be a lot of interest there. That's a very interesting space as well. It's also about which space you operate in. Are you a market leader? Are you a price setter? Are you a disruptor? Most of the IPOs that have come out in the last 15 months don't fit this bill. There will be few. Of course, I would say subscribe to an NSE, no question about that. Obviously, BSE has been a beneficiary of the kind of news flow that we've seen around NSE this week. But that's a case to case, right? I think, you've seen the euphoria on Bajaj Finance. To me, ho gaya. I think even at 30, if the company grows at 30%, to be paying 6.5, 7 times book, I'm not so sure. But there will be opportunities in primary markets. That the specific answer I was giving to your question of why I thought there was an interest, because I think in the secondary markets, people are actually running out of ideas because of the amount of ownership they have of individual stocks. That's not to say that I will not say buy an NSE or a Swiggy. We haven't put out research on that effect, but these prima facie look like very interesting issues, and they certainly could be considered.
Swiggy is hot, and how? I believe prices such as 350, 355 are doing the round, and I think any HNI is doing...
I'll just tell you on a lighter note, Salina, one of my friends is actually marketing Swiggy, and, she's a banker, and she's like, my phone hasn't stopped ringing over the last 1 week for Swiggy allotment. So that's, even before the issue list, I'm actually getting first-hand feedback from one of the bankers on the issue that all kinds of people are calling for any kind of allotment. And I'm sure the same thing will happen with the National Stock Exchange. And anything that's
I think Rahul, it's because people feel the FOMO of missing out on NSC. That Swiggy is seeing the sort of inflow that it is. But yes, they are filing a DRHP from what we understand as early as next week, a listing on the cards in the next few months. And of course, the valuations are at a deep discount to Zomato. That's what you want to keep in mind. And they've also done a down round a few months ago. But that's a separate conversation on the unlisted space. Rahul, thank you for joining us. We'll see you soon. But for now, no one can fight the flow of money. And that's what D Street has been witnessing.